That's what we're all about. Truth seeking, finding out what the lenders are up to. That sounds a bit sinister. Paul Glossop, CEO of Finni Mortgages, Property Finance Uncut. How you going?
I'm good, mate. I'm good. This is starting to get to the meaty end of these conversations. But it's been pretty crazy. Now we start to reflect back. We've been doing this for over a year now, and in that time, we have had the most fluctuation in the Australian property market finance space that we have had basically on record. Who would have thunk it when we started this? Literally 12 months ago.
And that's the catalyst of this particular podcast, was just to do a quick snapshot every single month when the Reserve Bank meets to work out what's going on. And we've ridden a wave, we've ridden
I'm sure you
the
have
wave,
plenty of
ridden the wave of
months.
these rate rises. And Paul, I was 50-50. I was 50-50 for the last sort of 3 weeks, whether or not we're going to get one more hike. And mate, we've stayed where we are. And I was listening to Mortgage Business Uncut with my colleague, who you know, Alex Whitlock.
Yep.
And he called it as well. And his view is that you just can't keep hitting people with these rate rises. You've got to wait to see what the impact and effect was. And I think that's what we're seeing this time around.
I think you're right, mate. And I think, to your colleague Alex's sentiment there as well. I think the reality now, the RBA is realising that not everyone's on a variable rate. And if anything, the last 2 or 3 years in particular has seen this huge amount of additional borrowers go from a variable rate previously to fixed rates to get those really attractive low numbers. But realizing that throughout the rest of 2023, there's going to be a lot of those borrowers who are going from a low fixed rate to a variable rate. Now, making that variable rate, which they are going to switch to higher and higher and higher, may see a far, far greater shock than intended. So I think they know that their numbers are kind of getting close to where they want them to be. Whether this is it, I think that we'll see over the next 6 months. But I guess the reality is now we're sitting at 3.6% now. And I think if you look at those longer term money markets and bond yield curves, that gets a little bit more technical. The next 12, 24, 36 months looks like we're probably going to see price of money come down anywhere between 0.3 down to even 1% in certain instances of certain economists.
Yeah, and I was 50-50 because I thought, the Reserve Bank, and they meet every Tuesday, except for January to determine what's going on with interest rates. And I thought, maybe they'll just do one more, just to make sure, that and there would be merit, and there would be merit to that as well. Yeah. I could argue, but I thought they'll do one more just to make sure they've impacted enough to get the effect that they want, and that's to curb consumer spending. Now, consumer sentiment's not good at the moment. It's a lot of people walking around. You just need to see it. Go to the shops, go to the pub any given day, and just have a chat to people about how they feel about their finances right now. And I don't know anyone who's going, yeah, she's apples, mate. Don't worry about it. Plenty of money in the bank. Everyone's concerned.
Yeah, mate, and that's exactly it. I think the only real differences between now and 12 months ago is essentially asset prices. And, if we really look at people, what doubles down their concern is that not only are they considering that the cost of holding the debts that they had 12 months ago has obviously increased for a $500,000 increase, well over $1,000 a month. But their actual asset that they attached that property to has obviously decreased quite significantly in value. I think where we're probably now seeing probably some sort of, a good baseline that the RBA probably wanted to see is that we're not seeing extremely strong deflation in asset prices. That's probably starting to stabilize depending on which market you look at. That could be still a bit of a dead cat bounce. And I think anyone who's thinking that this is the bottom and it's going to go into the roaring 20s scenario again might be a little bit more mistaken. But I think we're probably getting to that point where assets are worth at least 10% less than what they were worth this time last year. And the cost of holding those assets has increased exponentially compared to where it was this time last year. So, yeah, but I think the work is probably for the most part done. People are feeling poorer. That's the intention. We're going to have less money that's going to be free and available every single week and month to do what we want with, which was the intended outcome. We spoke about this right at the start of last year, saying the actual true crux of inflation is that people are essentially spending more and more for the same product, which in turn makes that product more expensive, which in turn means that over time, we need to figure out how to deflate that product or that service or that asset, which is kind of where we are now 12 months later.
Yeah, one of the areas, and people think it's counter-cyclical, but one of the areas where you can hit your everyday mum and dad Australian, whatever that looks like, is in their hip pocket, is you hit them in their mortgage. And that's the reason why they use that as a leverage mechanism to increase the official cash rate, which the banks nice of them. Always pass it on. But we've been speaking a lot about it, Paul, particularly when it comes to investment properties. But some data come out today, again, on mortgage business. It's mortgagebusiness.com. If you really want to nerd out on mortgages, go and check this out. It's super technical, but you'll learn a lot from it. It's saying that owner-occupier refinances hit a record high, Paul. And this is just a sage reminder, refinancing your investment properties, you've got to be right across this all the time. You can be quite tactical with that. You can move from principal interest to interest only, etc. But where most people hold their debt is their owner-occupier mortgages. And a lot of people forget, a lot of property investors forget to look after that first.
Absolutely. And quite literally, you've got to look after your home first before you look after anything else. And when we're going through the raw macro numbers are, something like 800,000 mortgages this year are going from fixed to variable. And I can almost guarantee that every single one of those fixed to variable debts is going to be a higher debt than what it was fixed for. So if you're thinking that you're going to roll from a fixed debt to a variable debt, and that variable debt is going to be the best absolute debt that the bank's going to provide you in the entire market, unfortunately, you're going to be very sorely mistaken. So I think it's absolutely no wonder to us at Finni that the reality is that that's where the bulk of the opportunity for people to actually shave cash off their actual repayments is, because this is A, the biggest debt, and B, where the absolute biggest amount of work has been done by the RBA. So if you are one of those 800,000 mortgages that's going from fixed to variable this year, or even if it already has gone to variable and you haven't actually looked under the hood to say, hang on, what did my rate actually revert back to? This is the opportunity to actually get in touch with your broker, get in touch with our team at Finni, because this is the time to actually sharpen the pencil. And the differences, we've spoken about this at length over the last few months, the differences of one bank versus another, or you staying with your existing lender to shopping it to another lender, it is enormous, the amount of money that's on the table for most people.
What are you seeing at the moment? Can you give me some sense of lender rates?
I guess, to put it really simply, if you're a principal place of residence sub 70% LVR, sub 60% LVR, and you haven't got a 4 or an opportunity to get a 4% rate on that debt, there are definitely lenders out there who are offering in the 4s. Even if it's a 12, 24-month introductory rate, they exist out there in quite a number of different facets. So do your math on that. If you see a 5 or even at worst a 6% in front of that debt, think that you should be seeing something pretty close to a 4 as the very first number.
Is this sort of PAYG people, not self-employed?
PAYG, self-employed. Self-employed, a lot of people who've been running businesses for 2 or 3, 4 years will look potentially as attractive as PAYG to banks as well. But I guess it comes back down probably more importantly to the actual principal place of residence. If your home has a circa value of $1 million and your debt on that actual value is sub $700,000, hence a sub 70% loan to value ratio, you're going to be pretty attractive to most banks as long as your serviceability is there. So that actual position, if not even lower, is where you can actually start to hunt around, because banks are super hungry for that type of opportunity. So I think if you're in that position, not only is there a chance to refinance to a lower rate, but even getting equity out and starting to think about investing and shopping with that extra money that's available, they're the two things which banks are very, very comfortable to lend money to at the moment.
Yeah, and you're sort of getting a bit tactical there, and we're not in the business of providing financial advice or anything. It's just a general conversation. But what you're talking about there is refinancing your principal place of residence to, one, get a sharper rate, but number 2, potentially extract some equity so you can capitalize if you're a property investor on this market.
Yeah, absolutely, mate. And I think, and that's where the difference of a good broker should be having those conversations with you. Is that your intention over the next 12 months, 24 months, or are you just wanting to refinance to get a sharp rate? Is that sharp rate going to also maybe even mean there's a $2,000, $3,000, $4,000 cash back because that's other things that are out there on offer? Is that something that's going to incentivize you more than potentially a sharp rate? And that's what a good broker or a good brokerage firm should be figuring out, is what's important for you. And let's try to figure out what the best opportunities and the best products are with the best lenders to fulfill those obligations.
Okay, so are we at terminal rate yet, Paul?
I think if we're sort of drawing out a line to say 2023, are we at terminal rate? I'll go out on a limb, and I think I'd say yes, we are, because if we do see a rate increase, I think within the next 12 months, we'll probably see that decrease to becoming sort of circa where we are now. If I say where are we going to end up, I think we're going to end up something with a 2 in front of it in the next 24 months.
Okay. I'm still 50-50. I reckon there might be one more.
When?
I'm not too sure, and I'm not an economist. I'm just a struggling journalist. But from my sort of armchair privilege, my armchair position, chatting with a lot of people, I just think there might be one more in it. However, I'll go back to the point. We need to wait and see whether or not the impact of these rates have truly impacted, and they're going to start getting inflation to a range that they wanted to get it in. Now, is it going to go back to 2 to 3%, which is the target range? I don't believe it will do for some time. I'm talking years. I think you probably need to accept the fact that you're probably going to have inflation at 4 to 5% for the next period of time, and that normally reflects sort of wage increases sort of happening outside of the mortgage environment. So it's just an inherent health of the economy. There's still a lot of supply chain constraints as a result of COVID, as the war in Europe. I do note that it's 1 year since the Russian invasion of Ukraine, and that does not look like it's going to end at any point in time. Whether or not, Paul, we can get more stimulus working here in Australia, we have great resources here from the building side of things. You think they make it a little bit more available to the punters, right? We need a few more trees knocked down potentially, turning the building, but it's outside of our pay grade, that sort of stuff. Give me one good thing about a mortgage before we leave, Paul.
One good thing about a mortgage.
Tell me one good thing about a mortgage.
It's pretty simple. A mortgage, as opposed to the actual technical definition of what it is, I like to re-envisage that as saying a mortgage is an enabler. And if you're thinking of a mortgage as that set of handcuffs or till death or whatever the definition you expect it to be, for me, mortgages are enablers. And if you think of it as a different term or a different actual position, I think you've got your mindset wrong. So a mortgage for me is always an enabler.
And I do note also there's some news coming out. There's more mortgage brokers in Australia than at any point in time beforehand. So obviously mortgage brokers are doing a good job. You're going to tell us that, no doubt. And if you want mortgages to be an enabler, you can probably speak to your team.
Mate, you know it better than I, mate. It's hard to find people to work with as you as a property investor, as someone who holds your owner-occupier mortgage, is to find a mortgage broker who actually understands you and is prepared to do the work to get you an outcome as opposed to feather their nest. At Finni, that's what we've spent the last number of years trying to do is get a crack team of people. Now, I note that every single one of our mortgage brokers are actually property investors who've worked in private wealth, who've worked in setting up large investment brokerage or large investment debts rather, and worked across a huge number of different debts over time in different banks. But I think one thing that, if nothing else, what people should and can take from today's announcement and action point here is that go back and look at your rate. If you're unsure whether it's fixed or variable, check it, get in touch with your bank, call your broker. And if nothing else, really ask the question saying, what else can be done? Because as I was saying earlier, if you've got an LVR sub 70% and you're not seeing something that's close to a 4% interest rate in front of it, you're not being serviced the right way.
There you go. It's Paul Glossop, CEO of Finni, and shout out to your team, Paul. Also, they're sort of 95% of the way through a refinance with me, and I'm not particularly the best customer. But I do know also, and everyone knows this, I am a shareholder in Finni business. I think it's a quality outfit you've got there, mate. So shout out to your team doing Cheers, that. Paul Glossop, Finni Mortgages, go and check them out, finni.com.au. Hope you enjoyed that, everyone. Well, hopefully that's it. I don't know. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.